Hello accounts people, time to have a look at capital allowances for limited companies. Sole traders can be dealt with separately, rules are slightly different, but then there's also lots of similarities. So we're going to replace depreciation, loss or gain on disposal of assets purely for our tax calculation purposes. We still leave the accounting profit as normal, and we still need all our ledger accounts associated with our non-current assets. So our trading profit, we're going to add back in depreciation, add a loss on disposal, take off a gain on disposal, and replace it with our capital allowances that we're just about to calculate. In this case, in a year where lots of investments have been made, we're now paying our corporation tax on almost £1 million less. Were there no investments, the likelihood is that the tax bill would actually go up as a result of capital allowances. I'm only dealing with capital allowance adjustments here. Obviously there are adjustments allowable and disallowable or taxed elsewhere as well to our trading profits. We can't use the values, our written down values for tax purposes in our main accounts. They'd be very, very wrong. There are items we can write down within a year for tax purposes, especially new plant and equipment, and we don't want to do that in accounts. We've still got them, we still own them, we would need our assets to have a value in our accounts. Nothing to do with leased adjustments, there's separate rules. You'd have to look at HMRC's website for that. Not much change recently in the recent Finance Acts. However, you'll only see anything from the 1st of April 2023 for the FYA first year allowance rules. Possible though, because we're now in the second year of it, the current rules that we might actually have more items for disposal. Anything to dispose of that was bought before that date, if there was any kind of allowance, you'd have to go on HMRC's website, which you're not going to do in the exam. So this is the template. This one's got all the columns. You may get a template that's missing a column because there's nothing to go into it, and we're putting everything into a pool. So pooling means we're just lumping them all together. However, a trader may decide to create a single asset pool and do the calculation item individually. That's optional. And some of the items where we claim the tax back very, very quickly, like the AIA, we could put them into the other columns if we wanted to. Not sure why we would claim less tax back though at any particular point in time. So first of all, the AIA, Annual Investment Allowance. So within the rules, second-hand or new, not cars but vans would be included. We're allowed to claim up to £1 million back immediately in our next tax return effectively. So our new asset that costs us £1.25 million, maximum allowance is in the reference material. Leaving us a balance of 250,000. So that 1 million is what we can claim back as a capital allowance against our profits to reduce our tax bill. It's a reward for investing in new machinery or second-hand machinery. End result, we've still got the 250,000. We just need to move that somewhere. If it's a new item, the 0 on, it can go into FYA for first year allowance. If it's a second hand item, it would have to go in the general pool or the special rate pool, but we'll deal with FYAs first. So again, very, very friendly, tax friendly rules. There's no limit on the FYAs, so if you were dealing with a reduced accounting year, you don't need to reduce it because infinity times anything is still infinity. Whereas the AIAs or any other calculations, if you're dealing with 6 months, you'd have to halve it. So that 250,000, the excess, needs to go somewhere. It can go in the FIAs in this case. Sole traders, it would actually have to go into the general pool, but one of the differences in the rules, and that's money we can claim back immediately in our next tax return. Again, reducing the cash flow issues, so it's a government mechanism for encouraging investment. They also like you to have zero emissions cars. So separate pool, again all that 28,000 came back in the next tax return. Doesn't matter if there is any private use, so you'll often see a percentage of private use in the exam to try and catch you out. The private user will have income tax and other charges associated with it, but not in the business accounts. The sole traders will need to do some adjustments for. So if we do some disposals, we can explain the other pools. Essentially though, the general pool is anything that doesn't fit into AIA or FYA. Most items, the special rate pool is specifically really for high emissions cars and some types of machinery that isn't allowed in the other pools. Hence we can't claim so much per year. General pool will also, any excess from the AIA or anything that any second-hand car that doesn't qualify for AIA, because we can't FIA them if they're second-hand. So disposals, let's get rid of an asset. Now this one's grey because it is a little bit grey in the calculations. So this asset was previously fully expensed. We don't need to know the cost, we just need to know the proceeds. So essentially what we've done, we have claimed 100% allowance when we bought it, but we've now sold it for 40,000. So some new item, bought new, sold fairly quickly. We've only got 40,000 for it, but we claimed all the cost price as an allowance. So we're effectively giving the government some money back. We're putting it back in, but then we're going to clear it out of our pool and just tell the government we need that back. Now it's grey because according to Kaplan, we're not going to have to show it in the actual computation. However, they do make the note it could be an objective test. That money's being given back to the government. No idea why it's not in the computation tables. Maybe it's just for clarity. Now we're next going to do an adjustment that reduces the value of the pool. So the general pool, we'll put something in to wipe it out and more. This is because the pool is a depreciated or tax depreciated value. These items may have cost a lot of money in the past and we're now disposing of them, but we've actually got £42,000 worth of proceeds. So these assets, should I put it here? It's the lower of cost and proceeds for the other assets, whereas the FYA we only needed to know the proceeds. So it's either cost us 42,000 or we got 42,000. Either way, it's the lower of the figures. So that gives us a negative balance on our pool, which means we've overclaimed effectively the capital allowances, not deliberately or fraudulently. We didn't know what the value of the assets and the proceeds were going to be when we sold them, what could be 10, 15 years later. So we need to do a balancing charge. So negative value is a balancing charge, and effectively give the government the money back. We have, of course, had it in our bank account and it's earned some interest or reduced our bank charges in the meantime. So it's not a complete loss giving the money back to the government. So the alternative, and the only one we're actually going to calculate an allowance for this year, would be an item that doesn't get rid of the balance. So we've now got 4,000 left in. So again, lower of cost and proceeds, it's now got a positive. So we're going to do our balancing adjustment based on the 4,000, the value left in the pool. And as it's a special rate, it's 6%, I'll show it as a negative figure, times the 4,000. And that 240 is an allowance that we're going to claim. That's where our number came from on our first sheet. and all we've got left now is 3760 carried forward the starting amount for our next financial year. A couple of other little notes there. Well, we've already mentioned we've spent a lot of money on new assets, so we're paying a lot less tax in the immediate future or next tax bill. Private use of a car doesn't affect the capital allowances for a company, one of their trick questions. I haven't seen any reference to the 50% first year expensing. This is for special rate items, so it'll be something like a second-hand car with high emissions. It's hard to work out even when you look at HMRC's website. I suspect anybody coming across one of those will be ringing HMRC or writing to them for an answer. And that's back to where we started. That's where that number came from.